Right now, some investors are making a fortune while others are getting wiped out. Same market, same economy, two very different scenarios. The difference isn't luck, it's strategy. And after 30 years and owning over 10,000 apartments, I've learned the plays that work in the good times and of course in the bad times and everything in between. Today, I'll give you my top 5 and I'll show you how they work for me in every single cycle, whether it's going up or whether it's going down. So in this market, everyone is guessing. Rates go up and people freeze. Prices dip and they panic. And they always wait for the bottom, even though they have no clue how to see where that is. But here's the truth. You don't have to guess. If you stick with these 5 plays, you can win in any cycle because they're built on fundamentals. They've worked for me in booms and they've worked for me in recession. And they'll work for you if you actually use them. Play number 1, buy where there's little competition. Now this seems rather obvious, but you'd be very surprised that people don't do this. Scarcity is your friend. Early in my career, I bought a massive condo complex in Las Vegas. Over 400 identical units. Same floor plans, same amenities. And here's the kicker. HOA has no rules around rentals, and they never do. So at any given time, there were dozens of owners after they were sold trying to rent their units, which were all the same. So when my units hit the market when I had a vacancy, I wasn't competing with 1 or 2 landlords. I was competing with dozens, sometimes even more. So we were all fishing in the same pond for the same tenants at different pricing. If I matched those offers, my margins completely disappeared. I remember one year, I just had 1 month of vacancy for the whole year, but it wiped out my entire year's cash flow. And some of you have those same margins today. So you can't afford 1 month's vacancy on a year's rent. And that's when I realized even a perfect property on paper will underperform if you have too much direct competition. When tenants have fewer choices, you can hold your pricing and therefore protect your profit. And this is why it works. Less competition means stronger negotiating power and more consistent income, which is exactly probably how you underwrote the deal. So the mistake to avoid is buying in an oversaturated area. And this, unfortunately, is oftentimes when prices are lower. Even if the demand looks strong, when too many similar units hit the market at the same time, rents fall fast and you start to see concessions. So scarcity protects your rent. But there's another lever that also creates profit, and that's play number 2. Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. So I call this forced equity. Forced equity means that you have a plan before you buy something that makes the property more valuable. This is part of your purchasing plan, and you're not waiting on the market to do it for you. I'll give you an example. We bought a little over 1,000 units in 8 different properties over 10 years ago. And the owner of those properties was not doing what was called RUBS, or resident utility billing, which means that the tenants were not paying for their own utilities. The owner was paying for all that. All of that equated to about a $500,000 expense that the owner was paying on behalf of the tenants. So just that strategy of slowly starting to charge the tenants for their own utilities over a period of time, which took a couple years, was about $500,000 more of income on the tenant side that offset the expense. And that $500,000 at a 5 cap was a $10 million value add. So before we bought the property, we knew that we could increase the income by $500,000, and that would also increase the value by $10 million. which is exactly what happened. And there was another time where we bought a property that had washer and dryer hookups inside of the units, but they also had a laundry room that people walked to. So by spending $150,000 and installing washers and dryers in everybody's units for free, we charged $50 a month as their leases started to expire. And eventually we were collecting a little over $10,000 per month for those washers and dryers. So that's about $120,000 a year for a $150,000 expense. Not to mention the value add you get from showing the extra $120,000 a year, which was also a couple $1,000,000. So for $150,000 in a washer dryer expense, we got $120,000 in income, which created a couple $1,000,000 in value as well. So that's what I mean by forced equity. And those plans were identified before we bought the property. So forced equity is in your control. It's something that you see before you purchase the property. You're not hoping for the market to lift your value for you. You're manufacturing it. So I see mistakes all the time when people try to do this. They make improvements that the property won't pay for. For example, they over-improve the interiors of the units, or they paint the buildings and they think that they're going to be able to get more rent for that, which is not true. That just attracts more people because the property looks nice. It does not directly go toward rent. If tenants won't spend more for the upgrade, it's literally just an expense. Now, speaking of protecting your investments, I put together something that I wish I had back in 2008. The Recession Survival Checklist. It's a step-by-step guide to secure your income, protecting your assets, and staying in the game no matter what's going on, no matter how bad the market gets, or even if it starts going up. It's completely free. Just click on the description below to get it. Now let's get into the third play. Buy cash flow first and appreciation second. You can't pay your mortgage with future appreciation. If the deal doesn't cash flow with conservative numbers, I walk away. I don't care how pretty the building is. I don't care where it's located. It has to cash flow because markets do go up and down, and you need the cash flow if they go down. Numbers first, emotions second. So one of my early deals looked perfect. But when I plugged in the real insurance rates and the property taxes after we bought the property, because the assessor will adjust those upwards to the sales price, the positive cash flow turned negative, so I passed. Even though I loved the location and I loved the property, it didn't cash flow as a result of just those two things. So 2 years later, that property went back to the bank. And this is why it works. When you buy for cash flow, you can pay your mortgage, you can cover your debt, and you have reserves, and you still put money in your pocket, no matter what the market does. And it also enables you to build reserves over time, so you have that safety net. So the mistake to avoid is to chase appreciation, especially, of course, in flat or failing markets. But oftentimes, you don't even know when that's going to happen. So that's called speculating, not investing. I call that gambling. You cannot buy something in the hopes that it might go up later. Cash flow keeps you alive. But what if you want to grow your wealth even faster without waiting for the market? Play number 4, use fixed rate debt to hedge inflation. Now there's two things going on here at once. The government is more than likely going to have inflation. Even the Fed on their own website says their target is 2%. So debt isn't the problem. Bad debt is the problem. The dollar is actually debt. Once Nixon took the dollar off the gold standard, it became debt. Fixed rate debt is one of the best tools that you can use as real estate investors. Lock in a low rate, hold the asset long term, let the tenant pay it off for you, and let inflation do the work. If your rents rise, but your mortgage payment stays the same, your cash flow widens each and every year. And don't forget, your tenants typically pay down your mortgage at the same time. So why does it work? Because inflation hurts savers. It hurts people on fixed incomes, and it hurts people that are relying on a dollar still buying a dollar's worth of stuff. But we all know that that's not where this economy is headed. It rewards owners with fixed rate debt. You're paying off the mortgage with future dollars, and the dollar, of course, is worth less. So fixed debt keeps your payments stable. But what happens when the unexpected hits? Play number 5. Keep an emergency cash reserve. Now this seems obvious, but you'd be very surprised how many people scoop that money or pay it out in a form of distribution and have no safety net. This one's not flashy, but it's a game changer. And it's exactly what's crushing people today. They don't have the cash to keep some of the deals that they bought just 2 years ago, so they're going back to the bank. Cash reserves keep you calm when things change and things get messy. Vacancies, repairs, expenses going up like property taxes, insurance, interest rate shocks, those kinds of things do happen, and they are happening. If you've got reserves, you make smart decisions. When the pandemic hit and during COVID, Ross and I already knew that we had 3 months of operating expenses for every single property in a reserve account. So we were in a very, very good position, not knowing the uncertainty of what was going to happen with the tenants even paying rent. We increased that later to 6 months. So today we have 6 months reserve for operating expenses on every single property that we have. So when other people froze, we kept operating and we started to look for more deals. But we were able to do that because we were able to use the reserves to cover any operating blips. So this is why it works. Reserves aren't just for survival. They put you in a position to play offense when others cannot. The mistake to avoid is thinking the reserves are lazy money. It's still money that can be distributed and it's still yours. It just sits in a reserve account anticipating things that could go wrong. So it's not lazy. It's literally just insurance for your business. So let's recap the 5 plays. Buy where you have little competition. Create forced equity. Buy cash flow first. Use fixed rate debt to hedge inflation and keep a reserve. If you follow these 5 steps, you don't have to predict the market. You just keep stacking your wins. One of the most powerful real estate tools is debt. Not the kind that keeps you broke. I'm talking about good debt, not bad debt. This is the kind that makes you rich. So in this next video, I'm going to show you how I use hundreds of millions of dollars of debt to create cash flow and pay almost no tax legally. Click here and I'll walk you through the entire strategy.